As a business owner or a tax professional, you're constantly dealing with this simple fact. Your assets, they lose value over time. So the big question is, how do you legally account for that wear and tear to reduce your tax bill? Well, the answer lies right inside Section 41 of the new Income Tax Act 2025. In this explainer, we're going to break down exactly how to calculate the written down value for your depreciable assets.
So here's our game plan. We'll start with a question that every business faces. Then we'll dive into the legal details of Section 41. After that, we'll get our hands dirty with the WDV formula, walk through a real-world example, cover some key compliance tips and common mistakes, and then wrap it all up with a quick summary.
All right, let's kick things off by looking at the core problem that Section 41 really aims to solve for every single business out there.
Think about it. Whether it's your factory machinery, your office computers, or even the furniture, none of it lasts forever, right? That loss in value is a very real cost to your business. The legal way to account for this is through something we all know, depreciation. And claiming it correctly is absolutely fundamental to figuring out your true taxable profit.
So, where do we find the rule book for this? That's where Section 41 of the new Income Tax Act 2025 comes in. This section is all about one thing, determining the written down value, or as we all call it, the WDV.
Now, for all you seasoned professionals watching, don't worry, this isn't a massive overhaul. The core concept is exactly the same. Section 41 in the new 2025 Act is basically the new address for what used to be Section 43(6) of the old 1961 Act. The principle of written down value is just being carried forward, so it's a pretty seamless transition.
Okay, here's a crucial point to remember about Indian tax law. We don't calculate depreciation on every single chair or computer individually. Nope. Instead, we group similar assets together into what's called a block of assets. The easiest way to think of it is like a bucket. All your office furniture goes into one bucket, all your plant and machinery into another, and you calculate depreciation on the total value of that entire bucket.
So, let's get into the nitty-gritty. Section 41, subsection 1, clause C lays out the exact formula for calculating the WDV of a block of assets. We're going to break it down piece by piece.
First up, we have A. This one's simple. It's your starting point. It's the closing WDV of your asset block from the end of the last tax year. That's it.
Next is B. This is everything you've added to the bucket during the year. So any new assets you purchased that belong in this block, their actual cost gets added right here.
And then there's C, which is for subtractions. This is the money you get back when an asset from the block is sold, scrapped, or destroyed. Now, a key rule here is that this deduction can't be more than the value of the block before the sale. This is a neat little mechanism to stop the WDV from going negative just because of asset sales.
Component D is a special one. It's for something called a slump sale. This is when you sell a whole business unit in one go, as a single package. In that specific case, the WDV of the assets you sold off gets deducted from your opening balance. And finally, we get to E, which is the actual depreciation amount you can claim. So how do you get there? First, you find the block's value before depreciation. You take your opening balance A, subtract any slump sale D, add your new purchases B, and then subtract your regular sales C. You apply the depreciation rate to that number to get E. Your closing WDV is simply that pre-depreciation value minus E.
All right, theory is one thing, but let's see how this actually works with some real numbers. We're going to walk through a calculation step by step.
Okay, so let's imagine a company. They have a plant and machinery block, and the depreciation rate for this is 15%. They start the year with an opening WDV of 10 lakh rupees. During the year, they buy a machine for 3 lakh, and then later on, they buy another one for 2 lakh. They also sell off an old piece of machinery for 1.5 lakh.
So, first step, let's find the value of the block that's eligible for depreciation. We start with our opening WDV, component A, which is 10 lakh. We add all our purchases, component B, which is 3 lakh plus 2 lakh, so 5 lakh in total. Then we subtract the sales, component C, of 1.5 lakh. That gives us a pre-depreciation value of 13 lakh 50,000 rupees.
Now, hang on. We've hit a critical rule that you just cannot afford to miss. And this is often clarified in guidance like FAQs for tax audits. If you buy an asset and you put it to use for less than 180 days in that tax year, you can only claim half the normal rate of depreciation on it for that first year. This can make a huge difference to your final calculation.
So how does that work in our example? Well, we know our total block value is 13.5 lakh. Out of that, 2 lakh is for the asset used for less than 180 days. So we calculate depreciation on the remaining 11.5 lakh at the full 15%. Then, on that 2 lakh asset, we apply half the rate, which is 7.5%. Add those two numbers together and our total allowable depreciation for the year, our component E, is 1,87,500 rupees.
And for the final step, we take that value available for depreciation, the 13,50,000, and we subtract the total depreciation we just calculated. That gives us our closing written down value of 11,62,500 rupees. And of course, this becomes our opening WDV for the next tax year.
Okay, now that we've got the mechanics down, let's talk about the practical side of things. How do you stay compliant, and what are the common mistakes that can get you into trouble?
Look, if you want to claim depreciation correctly, good record keeping is just not optional. You absolutely have to maintain a detailed fixed asset register. It's also vital you classify assets into the correct block, because that determines the rate. And of course, keep all your invoices, your sale documents, and as we just saw, be meticulous about tracking the put-to-use dates.
So what are the common traps people fall into? Well, misapplying that 180-day rule is a really big one. Another is when all the assets in a block are sold off, but people forget to reduce the WDV to 0, which has its own implications for capital gains or losses. And always use the actual sale value for deductions, not the book value. Getting these things wrong can lead to incorrect tax filings and, you guessed it, potential penalties.
All right, we have covered a lot of ground today, so let's just boil it all down to a few key essential takeaways.
So what do you absolutely need to remember? First, Section 41 is your go-to guide for WDV. Second, always think in terms of blocks of assets, not single items. Third, the formula is pretty logical. Opening value plus additions minus sales. Fourth, that 180-day rule is a game changer, so watch your purchase dates. And finally, and I can't say this enough, meticulous record keeping is your absolute best friend.
And that's our deep dive into Section 41. We really hope this has cleared up how written down value works under the new Tax Act. Getting this right is so key for accurate tax planning. If you found this explainer useful, we'd really appreciate it if you could like, subscribe, and share.
Just a quick reminder, this is an AI-generated educational explainer. The information here is for educational purposes only and isn't professional advice. Tax laws change all the time, so please always consult with your professional advisor before taking any action.